One of the biggest problems emerging managers have is they don't have the know-how or the expertise on how to spend their time. They believe a lot of conventional wisdom when a lot of it's not true. So my name's Guy Costin. I'm the founder, CEO of Dakota. Me and our investment sales team have created a show called the Emerging Manager Growth Show. What we do on this show is we demystify everything that a lot of conventional wisdom comes from. And the whole goal is for an emerging manager to be able to do more with less. And you have a very experienced team in myself, and I have each one of my team members on. We break down all the tips and tricks and techniques for exactly what an investment salesperson and an emerging manager should be doing to help grow their firm. Join us for another Emerging Manager Growth Show. This is one you're not going to want to miss. Hello, my name is Guy Costin, founder and CEO of Dakota, and the Dakota Way is officially live on Amazon, where you can buy it right now, both Kindle and soft copy. The Dakota Way covers the 4 core principles of investment sales, which is 1, set expectations, 2, know who to call on, 3, know what to say, and 4, have a killer follow-up system. These are our internal nomenclature for how we describe the things that we should be doing to become world-class fundraisers. It's all in the book. It's incredibly simple, which is the good news. You can buy it on Amazon. I promise you it works. And if you have any questions, you can always email me at guy@dakota.com. The book's available at Amazon right now, both in Kindle and softcover. Thanks so much and have a great day. What is up, everybody? It's Guy Costin, founder and CEO of Dakota. Welcome to our latest episode of the Dakota Way Sales Coaching. So I'm joined by my longtime colleague, Andrew O'Shea. Andrew, welcome.
Thanks, Guy. Good to be back.
Thanks for being here. So what we really want to dig into, first off, for those of you who don't know us, Dakota, founded in 2006. We've been a third-party marketer for the past 19 years. We've raised over $30 billion. We have an 8-person sales team who's in the marketplace every single day. And in 2011, we codified our sales process called the Dakota Way and wrote a book on it that launched in February of 2025. Andrew's been a core part of that since day one. We follow it. We believe there's only 4 things that you can really control and then 3 subtopics, and that's what we're going to get into in terms of the sales coaching. Before we do that, I want to dig in a little bit to, Andrew's on the road every single day meeting with investors. He follows the Dakota Way sales process. But Osh, here we are today, November 2025. There's always, craziness in the world, AI and data centers and spend and, all this crazy stuff. But what's going on in your mind in terms of, we work with about 8 boutique investment firms, from venture capital to mid-cap growth. Very, very hard lifts. We've had a lot of success. That's what we're going to talk about today. So you can see, even with the tough stuff, you can still have success. So tell us what's going on in the market today, in the fundraising market, in your opinion.
Yeah, it's been a very busy year and a lot of action taking place right now, setting up for 2026, which should be a great year as well. But certainly private alternatives have been top of mind. In the wealth channel specifically, that's been getting a lot of attention, whether it's through the wirehouses, but more specifically, we've seen a ton of M&A in the RIA channel, and these are becoming larger and larger pools of capital that are now creating a lot of their own commingled funds to create fund of funds in effect for their end clients. So seeing a lot of new opportunities there.
So unpack that a little bit, because for the audience, there's a good chance there's a lot of people maybe listening in for the first time that have an LP product. Mm-hmm. And everyone's like, do I need an evergreen fund? Do I need to be on iCapital? Do I need to have all this stuff? And what you just said right there, these RIA aggregators are getting so big. Well, we know in our database, we've identified over 400 RIAs that have their own fund of funds. Mm-hmm. And so we don't need to worry about product structure, because so many people now have their own fund of funds. They'll act as one investor into your fund.
Exactly. That's the ideal scenario for a GP, where the end RIA client can just aggregate their clients and have it be private equity, name of the firm, 2025 vintage, and they might have various exposures across large buyout, middle market buyout, venture growth, where they can aggregate their clients and then get them into a systematic private equity program similar to an institution, but we've just seen a lot more RIAs doing that themselves as opposed to going client by client to try and figure out who's qualified purchasers, does this make sense? So as these firms have grown and merged in a lot of cases, we've seen more and more opportunities come as a result of that, which is, again, more centralization, which is great for GPs calling on that channel.
Right, and I think the big takeaway there is one thing I didn't mention. In 2019, we commercialized our database and created a fundraising database. It's a global database across all channels, from family offices to sovereign wealth funds, RAs. We have amazing RA data, like 5,800 RAs that all use outside managers. But within that RA database that we have the Form ADV, and RAs have to report if they have a fund of funds, the name of it, everything. And so we've identified those in our database. We have over 6,000 fundraisers that use our data every single day to raise money. So we've identified that. So that's a great takeaway, just in terms of the opportunity, not having to have a special LP product or evergreen or what have you, or feeder fund. You can literally just use your existing LP and be fine.
Exactly.
Great. All right, so talk to us about where the wind's coming from this year. What's been the approach? Where have you guys had success?
Yeah, I think the approach has always been the same, which is following more of a sales process, which we're here to talk about today. But in terms of wins, I think clearly passive investing has done quite well this year. The flip side of that is you have a lot of conversations going on right now about index concentration and concerns around that, and how do we have active management that complements passive management. And so I think having more active strategies on the public market side within equities has been a spot that we've been having more conversations, seeing more interest. We've also seen international markets doing much better this year relative to the US, and I think that's been quite helpful for the people that have kept that exposure, but also looking at their portfolios and saying, hey, did this strategy actually perform the way it should have when we've seen this outperformance? So there has been some activity for strategies focus outside of the US market as well. But in general, I think it's higher active share, concentrated strategies. And then, as I talked about earlier, the private market side. Obviously, you read every day about how much money's been raised in private credit. Starting to see more interest and focus on real estate, whether that's real estate equity or the real estate debt side as well. And then lastly, diversifiers. So hedge funds can mean different things to different people, but I think with markets, valuations quite high, I think looking at hedge funds that really play that role in a portfolio of a diversifying strategy with lower correlations, it seems to be an area that's been of interest as well.
Great. So before we dig into the 4 core principles of the Dakota Way, I want to mention something. So my email is gui@dakota.com, GUI@dakota.com. If you want a free copy, I'll send you a signed copy of my book, The Dakota Way, really authored by the entire investment sales team at Dakota. So just send me an email with your mailing address. We'll shoot you off a signed copy. So everything we're going to talk about today, Osh, at the end of the day, works. We've proven it on both sides of the business, both the investment sales side and the software sales side. There's an underlying theme, though, in terms of the consistent application of these principles. These are basically, we've outlined, there's 16 things that you can control, 4 core principles, 3 sub-principles beneath them that are totally within your control. For the most part, everything else is out of your control. And I do a lot of coaching, so I'll jump on a Zoom with an investment sales team for one of our customers on Dakota Marketplace, have a conversation. They'll ask a bunch of questions that are topical. And there's like apprehension, where people are like, well, should I say this? Should I say that? And we'll get into that. What we try to do in this book is the whole concept of our sales coaching is it's a jar, Steve Covey, it's a jar with the rocks and the pebbles. And then you pour in the sand and the water. And what I mean by that is we're giving you the core principles that, if applied, I'm not going to tell you it's easy, right? Because we go through this, but it's actually not hard. It's just emotional, right? Because you're going to see everything that we go through deals with cold emails and cold outreach, right? And that is the secret. It's been the secret to our success. We've committed to it. We don't think twice about it. It's really amazing, but it's consistency. Osh, do you just want to talk about that before we dig in to the first core principle in terms of consistency and that discipline day in and day out?
Yeah, absolutely. It's all about following the process, and it can be emotional. There's times where you feel like things are working very well. There's times when you're not getting as many responses, not as many meetings. But the key is just to keep following that process as we talk about over and over. And one common myth we tend to hear talking to other marketers is, well, our strategy's out of favor. We're going to sit out from marketing for the time being.
Horrible idea.
And that just completely takes you out of the market. And we see situations all the time where there's strategies we may have introduced 12, 14 months ago where you think that might not be getting noticed, but it is getting noticed, and they circle back with you, 12 months later and ask to reconnect on the strategy because it's become more topical for them at that time. So even though you feel like sometimes you don't have a ton of momentum in certain areas, the key is just to not get emotional and follow your process.
Yeah, and what you're saying is market timing doesn't work in investing.
Correct.
Right? Yep. But market timing or sales timing doesn't work in sales.
Correct.
Right? It's the consistent application of sales. And if you're the boss listening to us right now, everything that we go through, okay, is in the absolute best interest of the salesperson. So getting your sales team to listen to these calls, to follow these principles, it's in their best interest. Like I said before, it's just emotional and you feel sorry for yourself, right? And we're going to get into that. But it's all doable. And if you consistently apply it, you win. So let's kick it off. Okay, so there's 4 core principles I'm going to go through. Number 1, setting expectations with your boss. 2, know who to call on. 3, know what to say when you're in a meeting. And 4, have a killer follow-up system. I'll preface this because it's the first sentence in the book, is nobody went to college to be a professional meeting setter-upper, okay? But that's what 50% of everything we're going to talk about has to do with that one activity, okay? Sending cold emails to book meetings on a consistent basis. Again, before we just start on setting expectations, just talk about that for 1 minute, just the importance of the consistent cold outreach. Because really, what this training, this is a little bit of a group session, a group therapy session, because we're sort of having to coach people off the brink in terms of, geez, did I really live my life? Is my life really just about sending 20 cold emails a day, trying to book meetings with potential investors? Yeah, that's a job.
It is. You have to be very thoughtful about how you're approaching cold outreach in terms of where you're spending time, which is another way of saying, am I focused on my total addressable market of qualified buyers? We like to say we sell apples to apple buyers, so we're not in the convincing business. If they don't do private equity, they don't do private equity. We're not going to go convince them to do private equity, right? So we're spending our time focused on cold outreach to the highest quality prospects, and then we're doing it in a systematic way, which one of the tools we use, which we'll get into, is city scheduling, which sort of forces us to take a very large total addressable market and create focus areas and sprints, so we constantly uncovering new accounts. New pools of capital are popping up constantly every single day. People will move, people change, people start new firms. So the process of cold outreach, make sure you're staying on top of that.
Great. Okay. So let's get into it. So we're going to run through this. Core principle number 1, set expectations. So this is putting yourself in a straitjacket. So number 1, you have to create a sales plan. You as a salesperson must create a sales plan. Then you must report weekly against your plan with your boss. So we sit down, you create the sales plan, exactly where you're going to focus your time and energy, and you're going to agree with your boss on what success looks like. And then you're going to sit down each week and go through your pipeline on how you're doing against your plan. Let's talk about why that's so important, because we do it each week with the partners that we raise capital for. We don't do it every 2 weeks. We don't do it once a month. That's crazy, because the law of 18 months applies here. You need to feel compelled to show up with your boss each week and go through your activity report and your pipeline. It might just be 5 or 10 minutes, but it's a forcing mechanism for you as a salesperson to make sure you and your boss are aligned, so you don't wake up after 6 months, your boss is like, so how you doing? What's going on, right? You want to be the dog, not the tail. Can you just make a comment on that? Core principle number 1?
Yeah, absolutely. Set expectations, and what we mean by that is not set expectations and just come out and say, I'm going to raise XYZ amount of dollars. It's about the process of fundraising, how we're going to approach fundraising, and then how we're going to measure our success to ultimately get to raising assets, which ultimately is outlining with either it's your head of distribution or a portfolio manager. They can be very analytical over the steps that you're going to take that lead to success, and then you can measure progress against that every week, so they can see the activities and the action that you're taking against the sales plan, and ultimately see the progress towards raising assets, which builds over time. As we know, these are longer sales cycles, and so the idea of showing all of your activity that you have completed in the prior, call it 90 days, what you have on the calendar the next 90 days, and then going through with them a pipeline and where do we stand with each of these opportunities in terms of next steps. And so that they come in every week and they feel very much a part of the process and can understand the expectations of the role, which is very important.
Yeah, and it's a forcing mechanism for the salesperson to make sure that they don't show up. You're not going to show up empty-handed, right? So it forces you to, because there's going to be one of two results. You're either going to go through your activity and your progress against the plan, or you're going to leave the job, right? Because you're going to show up empty-handed and your boss will be like, where's the activity? Or you're going to wait a month, which is a really big mistake because it doesn't put you in the straitjacket. Once a week is the way to do it. Mm-hmm. And so first off, you need to set expectations. That's the basic construct. And our umbrella principle of this whole sales process is focus on what you can control. You can control that interaction. You can focus and control your activities. Second core principle, know who to call on. We talk about this all the time, right? The product structure that you have drives channel focus. So what that means is if you have a mutual fund, now an ETF, an actively managed ETF has become more and more popular. That's a topic for a different day. Or a separate account, you're talking RIAs, banks and broker-dealers are the straight shot on goal,
yep.
Right? That's your TAM.
Yep.
So the first thing you have to do is establish your TAM. What is the best fit channel for your investment strategy? If it's small, you think RAs because they have discretionary capital. Mm-hmm. If you're on fund 3, private equity, what have you, now you start to open up the institutional channel. Family offices, et cetera. So it's really important to sit down and look at your investment strategy and your product structure and what is the greatest channel fit. So for instance, if you have a mutual fund or now an actively managed ETF, who are the biggest consumers of those products? Well, we know JP Morgan Private Bank, Wells Fargo, Morgan Stanley, right? Then you want to start to gin up those types of relationships. And of course, all of the RIAs are active investors of using those types of product structures. Do you want to comment on that?
Yeah, absolutely. It's about fit for your asset class, but also, as you mentioned, the product structure. And if you have a very high tracking error, concentrated hedge fund strategy, you're obviously not a great fit for retirement plans, most likely. So who would be a better fit for that? Probably family offices or endowments, foundations. That is a cleaner shot on goal in terms of buyers of what you sell. So as part of setting expectations, you want to establish the TAM and discuss with your PM or your head of distribution, why am I focusing on these channels? Because they're the largest buyer of what we offer as a firm.
Great. So one thing that is going to be a big theme here is the RA channel is the new institutional channel. We have 5,800 RAs that are qualified for our customers to call on, and that's not going anywhere. You got to make sure you have an RIA distribution strategy, and you're going after those RAs on a consistent basis. Now, once you establish the area of focus, your TAM, where you're going to focus from a channel perspective, you then need to go execute. And there's two ways that you execute. Number one, as Andrew mentioned before, city scheduling. So we always have 5 cities that we're scheduling for at any given time. You have to gamify this cold outreach. So you pick 5 cities, pick 9 o'clock, 11 o'clock, 1 o'clock, 3 o'clock, 4:30. Now you can mix it up, that's what we do. And then you are trying to go into the database and saying, okay, who's in Boston? I'm doing Boston, and then start filling out those meeting slots. So just give me the short strokes on what you think about city scheduling and how important it is to the overall success when a salesperson walks in the office each day, they have total purpose if they have those 5 cities that they're scheduling for.
Yeah, it creates total focus and takes a huge addressable universe and gives you that time of the day to really take it and focus on, as opposed to 1,000 RAs, you're looking specifically in one metro area. And one of the best things after doing this time and time again here is almost each time you go to a city, we'll use Boston as an example, if you've covered Boston a long time, in your head you naturally think, okay, I probably have met with everyone there. But I guarantee you, as you keep rolling the cities back on the calendar and you go back to Boston that next time, you're going to find someone new that you haven't called on before. So that's, again, part of the important piece of the process too, is it helps you stay on top of anything that's changed or new accounts or people that have moved as well.
Yeah, it's awesome. And we build our database around metro areas. So when you go into Boston, you can see by channel or New York, whatever, all the family offices, all the RAs, all the consultants, public pension funds, all the FA teams, all the FAs. We have all that information. Makes it very easy. Okay, let's talk about how to execute against city scheduling, meaning you have to send a cold email. And I'll kick it off in saying there is a very structured way. Remember, all this information is in this. And if you're tuning in late, Dakota.com, if you'd like the signed copy of the book, I'll send it to you. Just send me an email with your mailing address. We go through in detail how to execute in the emails, but we'll make it very simple, right? Each email, in order to get it open, we believe you have to say meeting request, date and time in the subject line. Why? Because when you get an email that says meeting request, you're like, oh, somebody wants to meet with me. Your natural inclination is to open that email. Confusing it or making it try to be witty or whatever can be, some people have had a little success tweaking it. This is kind of the straight down the middle approach. And you can tweak it, but this is the way that we do it, and we've had great success doing it. Subject line, meeting request, date and time. Then this is where the art form is, right? You have to take the time to write the 1 to 2 sentences max of why, who you are, what you do, and why they should care. They should get it instantly so they can make a decision in their mind. Hey, he wants to meet at 3 o'clock on Thursday, May 4th. Do I want to take this meeting? Can you just talk about how important the subject line and then the body of the email, keeping it so simple, clear?
Yes, so simple, clear, and establish credibility. So we're based in New York, X number of employees, very clear what the strategy is. We're raising Fund 3. I see too much of people try to use meeting request emails as like marketing emails where they're either trying to be cute about how they're pitching it, or they're literally just trying to give their entire pitch in an email meeting request, and that just gets lost in the mail. So you want the pitch to occur in the meeting, but you want to be very clear and brief and a call to action, and then they'll obviously be able to look at your materials as well.
Lastly, it should close out by saying, can you meet May 4th at 9 a.m. or 3 p.m.? Okay, you need to have a clear call to action. I see too many people saying, can you meet the week of, or can you do this? Now you're insulting your buyer. You're asking them to go to their calendar, do work for you, right, and figure out a time that works, right, the whole thing. That's crazy town. If you simply say May 4th at 3 o'clock, they'll go in and see what their schedule looks like May 4th. Yes, I can do May 4th, or I can do 2 o'clock, not 3. So pro tip though, back to the first the sentence, if you've done some homework on your particular prospect and you reference a podcast they were on, or their newsletter that they've written, or what have you, and you simply make a reference to it, hey, I really enjoyed the podcast, and I really want you to talk about this topic. I'm gonna be in Boston, I'd love to introduce myself. This is who we are, this is what we do. Can you meet at 3 o'clock on May 4th? So the pro tip is to do a personal reference of something you've read about them.
Yes, absolutely.
Okay. Right.
Very important in cold outreach. When we talk about cold outreach, we're talking about direct interactions with potential buyers. It's not, let's send out a blast email to 2,000 contacts.
Right, that doesn't work. Mass email to book meetings doesn't work. So if you're going to do that, just stop it right now. It's never worked, it never will work. It's a silly idea. But like I said, everyone feels sorry for themselves. Why did I sign up for a job that I have to send 20 cold emails each day to get the results that I want in life? But I'm going to tell you, you get the results if you stay committed to it. So core principle number 3. Now you've booked your day of meetings in Cincinnati. Now you have to go to Cincinnati. And before I preface this, I did a podcast with Stacey Havener. It'll be in the show notes. It's a PhD level. Okay, she gave a PhD level podcast. We didn't know it was going to happen, but she just did it. She's amazing on how to conduct a meeting. Then I became the student. I thought I was the teacher, and she was teaching me, right? And I thought I knew what I was doing. Now I do know what I'm doing in the meetings, but she took it to such a deep level. It's an absolute must listen. We're going to give you how Dakota structurally approaches a meeting. And so there's 4 components to a meeting. First off, it's the first 2 minutes. Once you do all the nicey-nicey and all that stuff, then it's game time. Right now the person's like, okay, who are you, what do you do, and why should I care? That's what's in their brain. And so you need your 2 minutes opening, okay, to center the conversation so that they know exactly what they should be listening for. So it makes it so much easier to get into a conversation. So it's that opening, those opening words are everything.
Correct. Yeah, we like to call it here like de-risking the conversation, which is that you're establishing credibility, so there's a very clear focus of what you're there to talk about at the meeting. It's very easy for them to jot down, okay, here's where they're based, here's what they do, 100% employee owned. They're not scrambling the whole meeting to find those things they're going to have to find anyway throughout the the hour long or however long the meeting is. So you really want to just get that out of the way up front. And so you can move on to the actual art of the storytelling and positioning of the strategy.
So keep it simple, keep it clear, okay, and tell them what they should be listening for, right? Tell them exactly what they want to hear, so then you can move on to the next section. So once you do that and they're like, all right, I'm clear, before you get going into your pitch, because that's naturally where it goes, is you have to ask them just a key question so then you can adapt, which is, what is your investment decision-making process? That's such a critical thing to ask, and I've seen so many people don't do that. Then they can't tailor their comments based upon how that firm actually makes investment decisions. Once you ask that question, now you're into Q&A. And this is where Stacey Havener says you need to have them talking 70% of the time. She gets very much into this behavioral approach. She goes, it's a Q&A, but if you can do less talking, more listening, getting them talking a little bit more, that is the optimal. It's very hard to do to get to 70%, but that is the goal, and nobody knows better than Stacey. And then lastly, once you go through your pitch and the Q&A and you build a relationship, this is where the follow-up comes in. The follow-up doesn't happen after the meeting. The follow-up happens in the meeting. Now, we know about 1% of people do this, but we're giving you the advice. We do it. This is how you save a ton of time. Hey, Andrew, really enjoyed today. Thanks so much for taking the time. Do you mind if I just ask you just 2 questions as we're closing out? Sure. I know I just went through our Spruce strategy, which is a construction loan strategy, private credit real estate. Would you ever see a strategy like ours fitting within your asset allocation mix? If you say, well, I enjoyed it, but you know what, it's just not a good fit for us. We don't do X, Y, Z for this reason. Or, yeah, I actually would see this fitting. Okay, great. We have a final close, March 31 of 2026. Do you think that's a close that you can make? And if they say no, it's too soon, or yes, then you know. No, mailing list. Yes, okay, what do we need to do, right, to inform you, right, to get you more familiar with the strategy? What would be the next steps? You have to leave the meeting with a current status and a next step. If you don't answer those, get those questions asked, Osh, what did we ban and what ends up happening when you come back to the office?
All you have to say is it was a great meeting, but
right.
No one knows what that really means.
Right, so we banned the term great meeting. You can't say great meeting. How was the meeting? It was a great meeting. Okay, does that mean they committed $10 million to the fund, like in the meeting, or wire $10 million in? Right?
That would be a great meeting.
Yeah, we just want to know what the current status and the next steps are. That's critical to close out a meeting. It's the ultimate time saver. And I even had, there's other terms that now have been banned according to our customers, which I love. And one of them said to me yesterday, they banned following up with, hey, I'm just circling back, all this other stuff, right? Which that's sort of for a different day. But I do believe as you're going on in your pipeline, you shouldn't be circling back with people. You should be providing value and telling them things that are going on and insights that you're seeing in a very short manner that relate to your strategy and your expertise in the subject matter of where you invest. So asking those 2 tough questions, right, Osh, is critical.
Absolutely, very critical.
Right, okay. Moving on to the 4th core principle, which is having a killer follow-up system. And what this means, Osh, is using a CRM to manage all of your activity in a most efficient manner. So tell me how important to you in your career, the past 11, 12 years, a CRM has been to your success.
Yeah, I think you used a term a long time ago that always resonated with me, which is that it helps you punch above your weight. And you have tons of accounts and pipelines and city scheduling, and so running a tight CRM, I don't think I would be able to do my job without it.
It's the only way that you can really 10x your productivity is with a CRM, because otherwise it's too much information, too many emails, too much activity, too many meetings set up, everything, and to have it all in not a centralized location that's easily retrievable is a disaster. You're going to be kind of a 1 to 2x type salesperson. However, if you can use a CRM,
yep.
And trust me, you might be saying, oh, Guy, why is Guy bringing this up, right? Well, because I have a lot of conversations with people and they don't use a CRM.
Correct.
They use an Excel spreadsheet,
Yeah.
right? They use yellow pad, paper, and Outlook. And it's crazy town, right? When there's these tools out there, they're so easy to use and input information. So the use of a CRM, talk to me about what we recommend. It's so simple. It's not a heavy lift in any way, shape, or form, but the orders of magnitude of benefit you get is, like I said, at least 10x.
Yeah, absolutely. And it creates calls to action, and that's what you want. You can't possibly keep it all in your own brain. And so we use it in a lot of different ways. One of the ways we use it is when we measure our TAM, which we talked about in terms of setting expectations. We have what we call the golden field, which is a sales cycle, and which basically tells you where do I stand against my total addressable market, and you can code your sales cycle based on whether you've just reached out, it's the long-term evaluation, or it's been moved to an opportunity. Ideally, you want all of your total addressable market over time to be in a sales cycle. You can get to that through city scheduling.
We talk about the golden field in the book. It allows you to categorize your accounts based upon where you stand against them. So it's a prospecting version of opportunities. So prospecting on one side, where you simply identify where you stand against all these accounts in Boston, so you know where to focus your time and energy. For instance, let's just say there's 100 RAs in Boston, and you started off and everyone was in the prospecting stage. Okay, as you advance over the course of a year, you might get down to where there's 50 in prospecting, and then there's the other 50 are in all different sales cycles. So then you know, oh, I need to go prospect those 50. I've already taken care of these other ones. They're in another sales cycle. Some, then you've created opportunities. So the golden field is huge. The second thing is it's mandatory. You have to get the meetings you've scheduled into your CRM, so you can create past activity reports, trigger sales actions. So you've got to get the meetings you've scheduled into the CRM and your call notes associated with each meeting that you complete. Even if it's a simple 1 or 2 sentences, you got to get something in there to give you the status of what happened in the meeting and what the current status and next steps are. And then lastly, with the CRM, as you create activity, then you have to create opportunity reports. They're very easy. We have all the details in here, but you have to create opportunity reports, because with one click, those opportunity reports, you can go look and see where you need to take action to move something up in the sales process. And then secondly, what do you use it for when you sit down with our clients or your boss?
For reporting.
Right. So it's very quick reporting. One click, opportunity, print it out, sit down, email it, hey, this is where we stand.
Yep.
So the two key areas that a CRM is super beneficial for, getting the meetings that you've scheduled in so you can have instantaneous follow-up to trigger sales actions, and 2, creating opportunity pipeline reports. The little pro tip that's in the book is the golden field that allows you to organize where you stand against particular channels and accounts. So it tells you where to go hunt, okay, but it also tells you where to go follow up. So, Osh, just recounting the 4 core principles of the Dakota Way is, number 1, set expectations with your boss. Number 2, know who to call on. Establish your TAM, use city scheduling and email cold outreach to book meetings with potential investors. 3, be a master messenger. So really control and be the maestro of that meeting. So you're clear about who you are, what you do. You understand them, get them talking, and ask the 2 toughest questions to close out. And then 4, have a killer follow-up system. Make sure you're tracking all of your activity in a CRM, creating pipeline reports for rapid retrieval of all your prior footsteps to get 10x leverage. So Andrew, that's the Dakota Way sales coaching. Any final comments?
No, and I think it's always a good refresher. And like we said in the beginning, it can be an emotional job, but we think if you follow this process and you stick to it maniacally, you'll see success over time, and rely on it.
Yes, and don't fall prey to feeling sorry for yourself that you were literally a professional meeting setter-upper. Submit to that as a lifetime, and you're going to end up having an amazing career. We've seen it time and time again at Dakota on both sides of the business. So with that, thanks so much for joining the Dakota Way Sales Coaching, and we can't wait to see you on the next episode of Dakota Way Sales Coaching. Hi everybody, thanks so much for watching. If you have an interest in having me come in to your team and speak to your team, a lot of people want me to come in to speak to the younger groups just about the 4 core principles of investment sales based on the Dakota Way book, I'd love to do it. I'd love to see you guys, and I'd love to help out any of your teammates as it relates to fundraising and techniques to make them a world-class fundraiser. Simply email me at guy@dakota.com.